right, guys, this is part 3, and we're going to talk about interest rates. All right, so Cory, can you tell us a little bit about interest rates?
Yes, interest rates, hot topic. This is what I'll say about interest rates, just to kick us off. Don't allow interest rates to prevent you from buying a home. I mean, seriously. I know I don't necessarily understand the psychology behind interest rates, but coming off of COVID, 3%, 2%, I get that part, right? But when you look at the other things that we pay for, interest rates are a lot higher than 6 or 7%, including your rent sometimes. If you're renting and you're paying $1,500, $1,800 a month, that might actually be more than a mortgage. So getting into a 30-year fixed rate mortgage where you don't have to move every 12 months could actually save you money over the long haul. So don't allow these interest rates to prevent you from actually buying a home. And so right now, just taking a quick look, at the time of this recording, the 30-year fixed on the conventional is 6.34, FHA is 6.04, VA is 6.06. So right now we're roughly down 2 points.
That's good.
Okay, yeah, because we had been in the 8s and things of that nature. So interest rates have come down some, but again, don't let the interest rate stop you, because once you get in there and we start working out numbers, looking at different types of loans, your actual 30-year fixed rate mortgage may come in a few $100s less than your actual rent.
Like if a person purchased a house, when can they refinance to get a lower interest rate if the rates are down?
Yeah, that's a great question. So, if the interest rates go down, well, first of all, let's make sure it's significant enough for you to actually refi. Because sometimes, if it goes down to half a point and you think, ooh, I get a lower interest rate because I went from 6 to 5.5, that may only save you a few bucks, a month, and it could take you 3 or 4 years to actually break even, okay? So make sure it's significant, but usually after 6 months to a year, I believe you could actually refi at that time, but that's not something that you would want to do just because the interest rate decreased just by a little bit.
Right.
Okay, so you want to make sure that it's a significant decrease. But with that being said, like for people who took out loans to buy a home when interest rates were really high, like 8%, 9%, now would be a good time because we're down to around 6%, 6.34. That's not bad, and that is considered significant. And if we go down to 4% in the future, then there you have it. You have that option, and I think that's really important to note. Also important to note is that mortgage rates are not necessarily determined by the federal rates. Okay, so you see the Fed cuts happening, things of that nature. Not necessarily the same thing. Our rates are based on what's called mortgage-backed securities, or MBSs, which is a totally different ball game. And so we operate on the 10-year yield. And so our rates may actually go down before the Feds.
Oh, really?
Yeah, absolutely. So like before the last cut, we were already down. We were in the 5s. But their cut actually sent them back up into the 6s. So we're not the same. Okay. Yeah, we're not the same. But it's still a great time to buy, even with these interest rates where they are. But buy what you can afford, obviously, right? Go out there and find, there's still opportunities out there. I guarantee you. It may take a little extra time to look, but get with a great realtor. And she's definitely going to make sure that you're where you need to be based on what you qualify for.
And let me ask you this, is this true or is this just a myth? If a person, let's say they're purchasing a home, if they pay one extra house note a year and apply it to the principal, does that knock the mortgage term down?
It doesn't necessarily knock the mortgage term down, but what it does is it knocks your principal down when you're paying anything above what your mortgage is. Right? And so you can pay it off early, right? You can pay it off early. And in most cases, there's not a prepayment penalty, So that's cool. So you actually get to save money by paying more, whenever you can, because you're gonna eat into the principal, and when you eat into the principal, you're actually eating into your interest rate, because your interest rate is going to be based on that lump sum of that principal, and if you make the principal smaller, and then that's how you ultimately end up paying the loan off early, because you've paid enough principal down to what affects your interest, and you can be done sooner.
Okay.
I hope that wasn't too convoluted. I tried to explain it as simple as I can. But if you can pay more, pay more.
Yes.
Pay it off early.
And apply it to the principal only.
But check this out. Can I say this? Statistically, most people sell their home after about 5 years.
Yes.
Anyway, so if you're looking for, that forever home, then you can kind of, but if you're looking at 5 years, and sometimes a fixed rate, depending on if you're going to be somewhere for maybe 2 or 3 years before you relocate, you might even want to consider an adjustable rate mortgage. Not going to go into details, but an adjustable rate mortgage is not a bad thing when you have a plan to not be in a home more than 5 years. And you actually know that you're not going to be there more than 5 years. Give it a trusted lender and devise a plan, and that actually will save you money as well. So if you have questions about an ARM, adjustable rate mortgage, that is, call me. We can have that conversation and we can determine if that is a good move for you versus a fixed rate. But again, if you're going to be in a home less than 5 years and you know it, that might be a viable option for you.
Awesome. Well, thank you. That was really great information. I appreciate your time. I hope we helped you. And any information that you need or you have any questions, give Cory a call. And Cory, may we have your information again?
Yes. 501-603-3773. 501-603-3773.
Awesome. Well, thank you guys. Y'all have a fabulous day. And bye.